Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, July 12th, 2024, S&P 500, currently sitting at 5632. I'm David Zarling. Ian McMillan is on vacation, so we brought in our resident sniper, Kevin Ferrari. Thanks for doing this again. I know you covered for me last week, and I appreciate that. Thanks for being back on here.
Yeah, no problem.
Lots to, as much as maybe the past few weeks or maybe even months or so, there hasn't been necessarily a ton to highlight. I think we might look back on this week as a significant week in this market. Is that too much hyperbole? Too much of a dramatic statement?
I don't think so. I mean, I don't know if it's just the fact that it feels like nothing's really been going on underneath the surface for so long, but I mean, we finally got some action out of some of these other areas outside of kind of like your mega cap tech.
Yeah, it's been a narrow market. Large cap tech has led the way. Perfectly normal behavior. We saw really broad breadth expansion November and December of last year, 2023. Since January, we've seen a narrowing. At the same time, stocks still experiencing a rising 200-day moving average across the board, but some weakness January through now, and even more apparent, I would say, April through now. So we've had this breadth deterioration, and I think it's safe to say there's an argument that shifted dramatically this week, potentially. We'll see where this goes from here. But anytime you have a move out of small caps like we saw this year, 2,000 stocks that are not in the S&P 500 move the way they did this week, I don't think that's bearish.
No, can't be, right?
I don't think so. I mean, the more stocks that are participating, the better.
Yeah, exactly. And then like seasonality wise too, right? I mean, kind of think that summer's, I guess supposed to be somewhat less active on that front. Now that we're kind of progressing through summer and small caps look like they might be kind of picking up the pace. I mean, it kind of bodes well, I think, for the rest of the year, which would kind of match that seasonal pattern as you get into fall.
Yeah, for sure. But to highlight the significance of this week, when you grow up and you go to school and you study economics, or you read certain economics publications, they talk about an efficient market hypothesis. Well, it turns out that it's a hypothesis, and that's about all it's good for. Because I don't know that we get to say this market is efficient.
Yeah, what is the next one down in that ladder, like somewhat efficient? Or I can't remember exactly what the term is they try to use. There's all those different.
Yeah, and even if, somewhat efficient markets, it's interesting because wouldn't that be the very definition of not efficient? If you're somewhat efficient?
You would think, right?
And I suppose there's got to be a spectrum of efficiency, but this goes back to, I forget the investing legend who said that markets are a weighing machine. It's about discounting the future 6 to 18 months in the future. And it's not about what price is doing today. It's about the opinions of the market for the future. And I know there was a famous book, Random Walk Down Wall Street. And I would say that markets aren't random and they're not efficient. Case in point, we had a move out of small caps this week versus large caps. So small caps outperformed large caps yesterday by 4.5%. And Ryan Dietrich and Charlie Boleo, both good researchers and technicians, highlighted that that's a once in 1.3 million year event.
Which blows my mind, just even trying to comprehend.
Yeah. And what's interesting is, so you would say, oh, wow, this is the first time that's ever happened. Nope. Like, for example, October 10th, 2008 was a 10 sigma move event, and that might ring true for some or have some significance to some because that was near a market bottom, right? Markets bottomed in March of 2009, but October, we started to see small caps. October 2008, we started to see small caps outperform large caps. These types of moves tend to be, interestingly enough, things that happen near market bottoms. So think about that for a second. Wait a minute. So we've been in an uptrend, one of the strongest uptrends of November through April that we've ever seen. Historically speaking, we just broke to new highs back in January. We're only 21 months, if we're using October of 2022 as a market bottom, into a new cyclical bull leg. Did this week just reaffirm the bull market cycle that we have more to go? I mean, that's to be determined. There's no way to know, but this is what it would look like. This is what it would look like.
Mm-hmm. Yeah, I mean, if you're bearish, I guess, after this week, I mean, I don't think there's really much hope for you at this point, right? I mean, that just has to be something going on with bias or something like that. I mean, it's hard to find too many things that have a negative outlook on the year at this point, really, or just as time goes on.
Exactly. I mean, we could have pointed to negative breaths, meaning less and less stocks participating, whether you're looking at January through now, or more acutely, I would say April through now. I mean, that you could definitely say that was cause for concern. It's a multi-thesis there. When you have a narrow market like that, are large cap stocks going to catch down? Is the narrow market going to catch down and be a corrective move? Or are you going to see an expansion of breadth? But you also had to be open to the 1950s and 60s scenario where the market just remains narrow for a decade. And it's not like this rotation that we saw this week, which, by the way, is the lifeblood of markets. It's not like this move out of small caps somehow negates the uptrends in tech and things like that. It just might mean there's different opportunities on the horizon as we move forward, right? A broadening market provides more opportunities.
Yeah, exactly. I mean, really at this point, I mean, kind of those value areas and small cappers kind of playing catch up at this point. You know, it doesn't necessarily mean like on a relative basis that all of a sudden those relationships change over more of a long-term outlook. But yeah, the more things going up, the better, right?
More fish in the barrel.
Mm-hmm.
Right? If we're shooting fish in a barrel, which sounds crazy, I should try that sometime.
Yeah, especially with the price of barrels now.
Yeah, I mean, how much is a barrel?
Oh, I don't know. I try to get mine for free when I can, so.
Okay. Are these like...
How about who you know?
Are you talking about like whiskey barrels like that?
Oh, I'm thinking like 55-gallon drums.
Oil drums. Okay.
Mm-hmm.
See, in my mind, I envision this barrel of fish being in like a half-cut whiskey barrel. I have no idea why, but the more fish that are in that, regardless of it's a 55-gallon drum or some type of bourbon cask cut in half, the more fish that are in there, the more opportunity there is. And that appears to be what we're on the cusp of. I'm not saying that's a guarantee going forward, but here you have small caps potentially thinking about getting a job, getting out of the basement, as I know our friend Ian would like to talk about, has been a disappointment for almost 4 years. We'll call it 3.5. And here we're sitting at potentially closing at a new weekly high for the Russell 2000 at 214. I mean, this is a price level we haven't seen since the middle of 2021.
Yeah, a long time.
And so if we're going to see a catch-up trade, a move where now the opportunity cost is to be narrow, that's about as bullish of an environment as you can imagine. Now, I might be getting ahead of ourselves. We know July is seasonally strong, especially the first part of July.
Mm-hmm.
I would argue the next 45 days, mid-July through August, the likelihood of some type of corrective behavior in the market is increased, but it wouldn't negate what happened this week.
Like, it's not like, right. I almost think that would be a healthy market behavior, right? Especially if you see this catch-up trade really pick up steam, and then things kind of just need to take a breather, right? Gather your breaths, so to speak. And then once you kind of get more into kind of fall, end of the year, heading towards the election, just kind of really pick up steam again.
Yeah, for sure. I think that scenario is definitely upon us, and it's great to see. Markets are a lot like rivers. Rivers pool in some places and they rapid in others, and that's how uptrends work. There's times where it's consolidating and there's times where it's trending. I believe one of the great technicians, it was either Marty Swag or Paul Tudor Jones, said the market is only trending about 15% of the time. So if that is upon us for small caps, where we're going to break out of this range, be above 200, and those are going to start to trend now, all it is more fish in a barrel.
Yeah.
What else should we cover here that our listeners might find insightful or useful?
Well, I mean, kind of touched on small caps. Okay, so I kind of said this a little bit with kind of mentioning value, things like that. But, recently over the last week, really your value sectors are kind of leading the market, which also kind of fits a little bit of that small cap theme. Like top 3 sectors this week were real estate, utilities, and materials. So, materials definitely kind of a high value area there. Industrials too, just under that. Healthcare trying to potentially close at all-time closing highs. Already, I think, had an intraday all-time high, I think, today. So, definitely some positive signs there.
For sure.
Because especially, industrials, too, that was a really nice consolidation there, and they're kind of heading towards the top of that range again. So it'll be interesting to see once it does when it gets there.
Well, we're seeing that across sectors, right? It's not just one sector. There's multiple sectors that have been consolidating. You brought up industrials using XLI, been in consolidation mode since March.
Yeah.
And we've seen that across the board, whether we're talking about healthcare or financials or materials. And that goes back to, it's a narrow market. Well, when you study what's happening with price elsewhere, rather than just the S&P 500, you can see that lots of places are consolidating after a massive November through April move that was historically significant, about basically in the top decile or top, I should say actually percentile of moves over a 6-month period or 5-month period. And then you're going to consolidate like this real tight. I would argue tightly, extremely bullish behavior. And we're 21 months into a bull market advance. I think we have to be open-minded that we're young, that this bull market advance is young.
For sure. And like within those sectors that were consolidating, it wasn't like nothing within there was going up. I mean, we dig into all like your individual stocks within those sectors. I mean, there's plenty of charts that I have really solid looking trends on an absolute basis, but really where I think a lot of the narrowness comes in is really just on a relative basis, just because of the move we've been seeing in a lot of the mega cap tech areas and just with the S&P overall. So, I mean, if you look at things more on an absolute basis, things even within those kind of broader sector consolidations have really been still looking pretty strong for the most part.
For sure. I think that this week, seeing broad participation pick up to match some of those absolute charts that you're talking about is a beautiful thing, and probably bear crushing, at some point. And really that's when this bull market will end, is when people stop shorting it. And we know that people continue to short it, and all shorting is becoming a future buyer. So we'll see how this market goes over the next few months. And as bullish as we're sounding on this episode, I should be careful because, as I alluded to before, mid-July through the end of August tends to be weak. But this week would still go down as being significant. And you could see a period of consolidation here happening. And then we move higher, as you talked about, September, October into the election, which is everybody's favorite topic. Is it though? I don't know if it's everybody's favorite topic. It's not mine.
Guess if it pays your bills.
Yeah, I guess if you're a news organization, you're selling ads, you're loving it. It's good for my kids because they don't even want to be on YouTube. There's so many ads.
Well, and the crazy thing is the amount of ads now, like on YouTube or other streaming platforms, still aren't even close to the amount of ads you used to have to sit through on, like your more standard.
Oh yeah, like old school
like national channels or like even just cable back in the day. I mean, it was literally nonstop, the same ads back and forth.
Mm-hmm.
Both opponents kind of just duking it out over the same 30-minute show.
Yep.
I mean, I'm trying to even think how many political ads I've actually seen over the last couple of weeks. Maybe a handful.
Yeah.
It's crazy.
It's picking up. There's a trend happening.
Mm-hmm.
And that's okay. So we talked equities quite a bit.
Mm-hmm.
I can kind of continue us down that path, but
I was actually going to ask you, really kind of the only sector that seems to be kind of left out of this most recent move is energy, which I don't know what necessarily think about that. I mean, really, kind of the sector that's been lagging the most. I think it's finally on the week, on today, just finally essentially got to flat. The week essentially is flat now, but it was negative.
Yeah, I think with energy, it's kind of along those lines of, is energy in a downtrend? It's not. Is it in an uptrend on an absolute base or on a relative basis, it's not. So while healthy on an absolute basis, and I would argue if you're using XLE up against really important levels that go back, to 2008, we're literally pricing wise on XLE, this 8880 level where we were in June of 2008. So that sector has provided 0% return for many, many, many years. And so while it's not necessarily showing any signs where you want to be involved currently, that could quickly change. And I guess I would put it in potentially the same bucket when we talk about bonds and interest rates. And I'm sure there's people listening to this who are like, what is he talking about, energy versus bonds and interest rates? Meaning that if energy costs are up, but at least they're stable, same thing, interest rates might be up, but if they're stable, that tends to be a positive market environment. I'm not saying people have to like $3.50 gas, but as long as that's stable for a while, that helps with input costs where people are, trying to run businesses. Same with the cost of money. If interest rates are up from what we've known for the past, 20 years, fine. But if they're stabilizing, that's a good thing. So you're right.
Plan a little bit as a business.
Yeah, it does. It's not like Client First has to run on oil, but there's plenty of businesses that do, petrols and everything. It's not just the fuel that goes in, cranes and big machinery or your car. It also goes into almost everything we make.
Yeah, plastics, right?
Yeah. And so if your input costs are stable and the cost of money is stable and the rules of engagement are stable, then that tends to be a good business environment. And so while XLE or energy on a opportunity cost basis versus S&P is down and in the downtrend, lower highs and lower lows with a falling 200-day moving average, that might not be a bad thing based on where we are on the absolute basis for it. So I just gave a really long-winded answer. I don't know if that's what you were asking.
Yeah, and I think, like sector rotation-wise too, I think energy is usually kind of one of the last, isn't it, to kind of show up in terms of like looking at a bull market cycle. You kind of expect that to be.
That's really good. I like that.
One of those.
Can you expand on that?
Yeah, so I think once you get more so towards where you would start experiencing more of your market top, you really start to get some of those kind of value areas like energy, think like materials, they really start to perform a lot better. Because really, I think it was last week, maybe 2 weeks ago, I can't remember, but Ian and I were kind of talking about what you would expect from a sector perspective, in like your earlier to kind of mid stages of a bull market. Really, as you're starting to pick up speed, has really been the only sectors we've been seeing, participating to the upside, really like technology, communication services, kind of the top two, maybe a little bit out of discretionary. So, kind of the flip side of that, right? When you're getting more towards your market top, I think you're generally expecting energy more so to be the leader there, which it kind of was, over the last bull cycle that we experienced. Energy really kind of seemed to stand out at that point.
Completely agree. Your point just simply being it could be fine on an absolute basis, but it's not a leader. Mm-hmm. Once it starts to be a leader, that might be something we want to pay attention to.
Right.
As being a characteristic that happens towards the end of a market cycle, for sure.
Right.
So we got these.
To your point, I don't think that's necessarily anytime soon, the way it's looking now, right?
Yeah, correct. Yeah, if you're a box checker, as you were alluding to before, bullish characteristics continue to line up. Now we'll see where we are in the next few months. But I mean, the table is set once again for bull market behavior going into the end of the year. Whether that happens, I have no idea. But if you were to set the table and what would it look like, this is what it would look like. Anything else you want to cover? I know we've been equity centric. We could talk bonds, crypto, commodities. I mean, we touched base on energy a little bit here, but any place you want to take our listeners?
Well, it's just because you kind of alluded to this with bonds, right? They're just as long as they're more so stabilized, right? Not necessarily going down or rates essentially stabilizing. I think on the commodity front too. When you look over the last couple of years, like especially I think a lot of these energy commodities have kind of more so stabilized, or at least looks like they might have found a bottom. Even kind of similar to, well, really the sauce, they've actually been performing pretty well. That's kind of one of the few areas like orange juice, coffee, cocoa we talked about a while back being really strong. Metals too, more so on a recent basis. So commodities broadly at least looks like it kind of at least stabilized, with some of them performing pretty well over the last couple months, which from like a business cycle perspective too is nice to see. At least they're not going down, right? That just adds to that bullish thesis there, really, which is good to see.
Yeah, I would agree. Now, I know you guys touched base a little bit on crypto last week.
Mm-hmm.
I would say it's interesting how, in addition to energy stabilizing and interest rates stabilizing, that you're seeing a dollar that is now in also stabilizing mode. I mean, we're back in a range that's been in place since late 20, and maybe that's a clue, right? Late 22 is the cycle bottom for the equities. And so we remain below 107 on a trade weighted basis using DXY. And I think a thesis could be made that as long as you're below 107 with a trade weighted dollar, bull market is intact. And yet you see something like Bitcoin, which is priced in dollars, struggling below a 200-day moving average. Now, does it get accumulated here? It's a higher beta product. I mean, the lows that we saw just a few weeks ago during the holiday week of 4th of July, I mean, it was close to being back to where the Bitcoin ETFs had been approved. So was that just a check back into when those products came to market and we move higher from here? I don't know. I wish I did. I would wish I knew, Kevin.
Oh, it'd be nice. I wish you knew too.
So all in all, a pretty productive week from a market standpoint. I would call it a mile marker of the market. This 6 standard deviation event that happened with small caps versus large caps. Again, small caps versus large caps remain in a downtrend, but it's interesting where this took place from a historical perspective, right? This is taking place versus the S&P 500 versus large cap tech, near levels that go back to the year 2000. And you're having this type of flush and rebound happening. And we know that these type of large caps or small cap versus large cap spreads are happening near market bottoms. And here we're talking July of 2024, 21 months into a bull market cycle. I mean, are we going to be looking back 6 months from now and this was a little bit of a launch pad for the rest of the year? It'll be interesting to observe.
Yeah, I don't think you can be surprised if it is.
Right. Exactly. That's the right way to think about it, is this type of information that we got this week. If we are higher, by December of 2024 or higher by April of 2025, we don't really get to be surprised by that because all the information is right in front of us. And that's why we're so thankful for technical analysis. That's why we're a technical analysis shop, is it really doesn't matter what our opinion is, whether we thought a debate went well or a presidential candidate is fit or the CPI comes in at X. Could care less. If we're just looking at price, the interaction of supply and demand, we're going to be okay. And using the tools of technical analysis, the study of supply and demand, we could see that this week was a significant week. We'll see if that holds true. And if you don't mind, Kevin, I'd like to highlight the supporter of this podcast at this time, the Adaptive Select ETF listed on NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Kevin, thanks for being on here. Anything else you want to touch base on before we close this one down?
No, I don't think so. I mean, I think you literally just read my mind with your kind of closing comments there. Because I mean, literally was just thinking, with the way we go about looking at markets with technical analysis. I mean, really, whether or not this does materialize the way we've just been talking about really doesn't matter, because we don't have to lock in any actions today, right? And project those forward. I mean, you can kind of talk about what it looks like, in terms of kind of like what it's foreshadowing. As price reacts, you can react with it, but really it's about as flexible as you can get, right? Which is great.
It is. We don't have to be married to our opinions. We get to marry our wives and raise our children and leave the opinions alone.
For sure.
It's great. So thanks for being on here. I really appreciate it. You always do a great job helping us out and providing insights. If our listeners enjoy this, we ask you to share it on your favorite social platform, or go ahead and give us the highest ranking you can on whatever you're listening to, whether it's on Spotify or Stitcher, or I don't even know. There's a bajillion of them. Whatever you listen to this on, give us a high ranking. That helps us get the word out. We know we're putting this information out for free. We hope you enjoy it. Thanks for listening.
Thanks. Have a good weekend.